Hi everyone, in this video I'm going to take a deep dive into DraftKings stock third quarter 2022 earnings call, so let's get right into it. Starting with the CEO Jason Robbins, he comes out and says that in the third quarter, new features that they rolled out around the start of the NFL season, such as quick parlay, quick same game parlays, and the ability to combine same game parlays, caused the parlay handle mix to increase 500 basis points year over year in the third quarter. So, what is a parlay? I think most of you that are following DraftKings stock probably know what a parlay is, but it's when you place multiple bets in the same wager on a company. So you say I want to bet on the football score being over, a combined score being over 60, and at the same time for the Tampa Bay Buccaneers to win by more than 7 points. So in order to win the wager, the Buccaneers need to win by more than 7 and the total score needs to be over 60. Otherwise, you don't win the bet. Okay, so these types of bets increased by 500 basis points year over year in the third quarter. And what's important to note about these type of bets is that they are more favorable to the house. In other words, they're more favorable to DraftKings because players win these bets less often, right? The probability of winning the bets, the parlays are less likely than the probability of winning single bets, right? So this is good news for DraftKings as the percentage of these types of bets increase, it could increase profitability for the company. And the fact that it rolled out new features around these types of wagers is good news. Another major milestone in the quarter was that the company launched in Kansas on September 1st. And so DraftKings is a gambling company, so they need to gain market approval for each state that they enter. And Kansas was one that they just got approval and entered into September 1st, and they got more rapid customer acquisition on a population adjusted basis than they have with any other state launch. So that's good news. And that's been the trend with DraftKings over the last, I would say, 8 quarters or so, is that with each new state that they're launching, they're getting better and better and better with the launch process, with the initial customer acquisition, with the sales and marketing spend. So they're steadily rising along that learning curve. And based on the states that reported operated level handle and gross gaming revenue data through September, we are capturing GGR share that is at or above their long-term target. So they're gaining market share at a rate that's above their long-term target. And based on estimates I've looked at, the mobile gaming market is, estimated to be around 30 billion. You'll find some estimates higher, some lower. And DraftKings is estimating that they'll get about 10 billion of that 30 billion dollar overall market. So they're estimating a pretty significant market share, over 30% in the long term. And here they're saying that so far they're going at or above that long-term target. So that's good news for long-term DraftKings stock investors, that so far they're gaining market share above those long-term projections. And a 30% projection is already high to begin with, and so far they're doing even better than that. In September, they were selected as the partner for Amazon's Thursday Night Football. And that's good news, right? Because it gives them exposure. It gives DraftKings exposure as folks watching the Thursday Night Football games on Amazon will see the gaming odds provided by DraftKings. And so if they're looking to place a wager, DraftKings will be top of mind with these customers that are watching Thursday Night Football on Amazon, which is millions and millions of customers that are watching Thursday Night Football on Amazon. The third quarter revenue of 502 million was much higher than expected, and this was supported by favorable sport outcomes. Now this means that they were they won more of the bets that were placed on the website, and this could be in relation to what I noted earlier with more of the bets being parlays. And so DraftKings tends to win more of the parlay wagers. And so this is already showing evidence of being profitable for the company. And they have shifted more attention towards cost controls and the path to profitability. They identified over 100 million in annual cost savings that have significantly slowed year-over-year fixed cost growth, as evidenced by their third quarter results. And yeah, this is good news for investors to see. DraftKings has notoriously been a really fast growing company, but what has plagued DraftKings as an investment from stock investors' perspective is the massive losses on the bottom line. So I think it can afford to reduce some of those costs on the bottom line, even if at the expense of some of that top line growth, because it's got really good growth on the top line. I think it can afford to sacrifice some of that growth to, reduce some of the losses on the bottom line. They shifted more attention. They're also seeing a benefit to their marketing efficiency from shifting towards national advertising and away from local spending, considering that they're now live in with sports betting in 18 states that collectively represents 37% of the population. That's good news. In the third quarter, they acquired more new customers at a 10% lower average CAC. CAC stands for Customer Acquisition Cost relative to the third quarter of 2021. And looking ahead, we'd expect our CAC to decline as our state footprint continues to expand. That's good news for DraftKings stock investors. Although I will push back a little bit here, a 10% decrease in customer acquisition cost is not that significant, especially when you consider that, let me backtrack a little bit. I follow a lot of the advertising companies like Alphabet, like Facebook, Pinterest, Snapchat, Twitter, all of these companies, Disney, some of the media companies that sell advertising, and they've all alluded to the fact that the price per ad has decreased significantly, double digits at least for, I know off the top of my head, double-digit declines in Alphabet and Facebook in the price per ad, and the two collectively represent roughly 50% of global advertising revenue. And they reported that price per ad is down at least double digits, approaching 20% decrease in the price per ad. So this is one area where DraftKings undoubtedly spends money on sales and marketing. And so they're reporting that the price per ad is down at least double digits, while DraftKings is saying customer acquisition cost is down only 10%. So this is an underwhelming improvement for the customer acquisition cost, considering the macroeconomic environment that we're in right now, right? The advertising environment has had a major slowdown. The price per advertisement has decreased substantially. And so for DraftKings to report an only 10% decrease in this regard is a bit underwhelming. Okay, so even though they're highlighting this as an improvement, it is an improvement, yes, but it's an underwhelming improvement. I was expecting to see more, following what I saw from Alphabet and Facebook and Pinterest and Roku. I was expecting to see more improvement from DraftKings. Hopefully, looking ahead, this will improve. This improvement will accelerate. I'm hoping to see an at least 15% improvement in customer acquisition costs in the next quarter. Moving on, they're excited to raise the midpoint of the revenue guidance by 45 million. Their guidance now includes the launch in Kansas as well as expected launches in Maryland in the fourth quarter and the pre-launch marketing investment in Ohio that they expect in January of 2023, with both Maryland and Ohio pending licensure and regulatory approval. So this is again, good news that they're gaining access to more states. Although the one big elephant in the room that's missing here is the approval in California. Voters here in California look to have rejected the ballot measure that would have legalized online sports betting. And this is a big blow to DraftKings stock investors that they're not expecting 2022, of course, to be in California, but it also looks like they're not expecting to gain approval in California in 2023 either, and it remains to be seen if they will ever get access to the California market, which is massive. The California sports betting market could be massive. For 2023, they're introducing revenue guidance of 2.9 billion at the midpoint and adjusted EBITDA guidance of negative 575 million to 475 million. So negative 525 million at the midpoint, which is a significant loss when you think about it. Let's say $525 million loss on, and that's adjusted EBITDA. That's not even EBITDA. So regular EBITDA would be even worse. Unadjusted EBITDA would be even worse. So an EBITDA loss approaching 600 million on revenues of 3 billion is pretty significant, nearly a 20% loss margin. And this is what has DraftKings stock investors cautious. This is in my opinion the significant reason why DraftKings stock is down so much in 2022 is because of these major losses on the bottom line. Thankfully, they expect the fourth quarter of 2023, in just 1 year away from now, to be their first quarter of positive adjusted EBITDA. That's great news. And then they, according to their multi-year plan, they will be approximately break even on adjusted EBITDA basis in 2024. So finally, investors can see the light at the end of the tunnel when these massive losses on the bottom line will start to diminish and eliminate, hopefully. And here they elaborate on what I talked about earlier. The Californians will vote to legalize OSB on November 8th. The results of this vote is primarily in, and they are negative. And they kind of knew this going into it. They're saying they're still deploying some grassroots effort, but most recent polling suggests an unfavorable outcome for their coalition. The DraftKings has discontinued cash investment in the campaign, but they already put in 17 million of their own money to support this campaign with advertisements and other measures. So really bad news for DraftKings that this measure was defeated, and it was defeated by a large measure. The most recent poll I saw showed 80% against and only roughly 17% in favor. So this was not only bad news for this year, but bad news for if they were ever expecting to gain access to the California market. The fact that they lost by such a wide margin really diminished the chances of this ever happening. Still, their long-term outlook doesn't include the fact that every state will have access. They're only looking at states comprising of 65% of the US population, which will ultimately permit online OSB, sports betting, and 30% for iGaming. And so 65% for sports betting and 30% for iGaming. Well, this is important because California is about 10% of the US population. So if you're not going to get access to California, that's already 10% of the market off the map for DraftKings. But that remains to be seen. It's not a foregone conclusion that they will not gain access to the market. Okay, moving on to the CFO, Jason Park. He was talking about the positive news from Kansas that generated a negative 8 million of net revenue in the quarter, consistent with the new launch playbook. So you might ask, a negative 8 million in revenue? How can you have a negative figure in revenue? And that goes to how they need to account for revenue. Typically, when DraftKings enters into a new state, they launch a lot of promotions to get customers to sign up. For example, they might have an offer that says, join DraftKings, deposit $500, and we'll match your $500 deposit with a bonus of $500. So customers that deposit $500 actually have 1,000 in their account. And so that works against the revenue. Um, but good news for investors that net revenue growth benefited from less promotional environment in the third quarter. That means its competitors and itself were offering less of these kinds of promotions in the third quarter of 22 compared to the third quarter of 2021. Still, they reached 1.6 million monthly unique players in the third quarter, which was 22% higher from the year before. In September alone, they added 27% player growth to 2.7 million, but September is typically their strongest month of the year due to the kickoff of the NFL season. The average revenue per monthly unique player also more than doubled to $100 with solid gross margin flow through. So this is what I've been saying with DraftKings. I've been following DraftKings stock for several years now. And, this is one of the companies where they are experiencing massive losses on the bottom line. But what I have been seeing from them is that they're getting return on that investment. They're seeing solid customer growth. They're seeing solid growth in the average revenue per customer. So they're getting good returns on their spending. So it's not like they're spending all of this money without sufficient return on that investment. If you've been a subscriber to my channel, you'll note that Scales is another company that I follow, which I compare to DraftKings because they also experience massive losses on the bottom line due primarily to spending on sales and marketing. But Scales doesn't experience the kind of return on the investment that DraftKings is experiencing. Scales is actually losing players. Their average revenue per player is not growing as nicely as DraftKings is, and so they're not getting that return on investment. And so I'm a little more critical on Skills management for their losses on the bottom line because they're not getting a good return. With DraftKings, I can understand management continuing to spend on sales and marketing because they're getting a nice return on that investment. At least if you look at the unique player growth and the average revenue per player, they're seeing excellent growth here. And so it's understandable that they would want to continue their investments to attract and retain players. Okay, with that said, that will be the end of this video on DraftKings third quarter earnings call deep dive. I hope I've added to your investing journey. If I have, please go ahead and hit that like and subscribe button. It'll really help me make more videos like this one. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for all investors of all skill sets and risk levels. So I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 3 times. Go to fool.com/parkev to get your 10 stock picks now.